folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. Equities had a very, very impressive month of July. We were down a little bit for the first couple of days of August. We're having a great day today. The S&P 500 is right at about 4160 as I'm talking to you. Over the past month, equities are up 8.5%, 9%. Bonds are up about 2.5%. It's been a very positive month for asset values, and that's really been driven by a couple of factors. First, we started to see second quarter earnings numbers, which over the past 2 weeks have come in, I think, far better than analysts were expecting and far better than people were fearing. So revenue for the S&P 500 is up about 15% year over year. Earnings are up about 10% year over year versus expectations of more like 3% growth for earnings and 10% growth for revenues. So if there is economic trouble out there, or if inflation is going to push on companies' costs, they are not seeing it yet. That is certainly the narrative that you would take away from the first 2 quarters of the year. The second thing that I would just note is that, in the last 30 to 40 days, we've heard increasing talk of, not a concern as to whether or not we will get inflation under control, but, okay, in order to get inflation under control, will we need to have sort of a little mini recession towards the back half of this year, early next year? And interestingly enough, you see the market rally into that type of conversation, because the market, and I think rightly so, views inflation, getting inflation under control as more important to the long-term health of the economy than necessarily sort of a short-term pullback associated with the demand destruction necessary to kind of get inflation under control. So you see that continued debate out there today. GDP actually contracted by about 1.5% in the first quarter and by about 1% in the second quarter. That would be news to anyone on Main Street, based on employment data, based on, the profit levels at Wall Street, based on unemployment claims, based on consumer spending patterns. It's really the first time that we've seen, sort of GDP global weakness, in spite of all these other macro indicators that are all looking positive. And so there's really a debate over whether or not you can actually call it a recession or not, because, yes, the headline number is moving, but all the minor indicators are still in the positive. So I think going forward, we are now probably 80% of the way through earnings season in terms of companies reporting. Knock on wood, we'll continue to see positive results, which I think will be supportive of the equity markets. And then we'll continue to see a debate around inflation and what interest rate level rises are necessary to get it under control. So that'll be really the next target or topic for the market to sort of wrestle with. As always, I hope you're having a wonderful week. If you have any questions, please feel free to reach out to either myself or to your advisor, and we look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please don't forget to subscribe and click the bell so you can keep up to date with everything new at RFG. If you want to learn more about who we are and what we do, please visit our website at rfgadvisory.com.